This video is about a specific disclosure that's required about the concentration of your customers. So let's take a look. And the rule is in Regulation SK, which SK is the rule that determines what is required to be contained in Form 10K. And the rule states that a company has to disclose the name of any customer and its relationship, if any, with the registrant or its subsidiaries shall be disclosed if sales to the customer in an aggregate amount equal to 10% or more of the registrant's consolidated revenues, and the loss of such a customer would have a material adverse effect on the registrant and its subsidiaries taken as a whole. And you can boil this rule down as saying if a customer represents 10% or more of your sales, and many companies also apply this to accounts receivable, so 10% or more of sales or accounts receivable, you have to disclose this fact to investors. And so let's take a look at an example of this type of disclosure. And the company we're going to look at is Ball, which is a Colorado area company. And Ball has kind of two divisions, okay? So they do kind of spacecrafts, and they also do canning and bottling, okay? So Ball has two divisions. And here's Ball's disclosure with regard to customer concentration. And so they title this section Major Customers, and this is within their 10K because it's required by Regulation SK. And here they say that net sales to major customers as a percentage of consolidated net sales were as follows. So they say the US government, so they probably sell their spacecraft and those types of products to the US government. And that represents in 2019, you see that that represents 13% of their total consolidated revenues. And total revenues you find on the income statement. And 13% of that were sales to the government. And so they're reliant on the government as a concentrated customer. They also have major sales to Anheuser-Busch, InBev, and affiliates. So that's their canning and bottling business, right? And so that's also a major customer. And 12% of their consolidated revenues relate to Anheuser-Busch. And finally, 9% of their revenues relate to Coca-Cola. And so they didn't technically have to disclose that in 2019 since it was under 10%. But as you can see, in prior years, this was a significant percentage of sales. And so to be consistent, Ball disclosed Coca-Cola as well in 2019. So here's Coca-Cola's disclosure of their customer concentration. And you can see that their sales are pretty heavily concentrated in these three customers. And so you will not find any disclosure at all if the company is reliant on a great number of customers and no one of those customers represents more than 10% of revenue or accounts receivable. And just some academic research related to customer concentration to bring in here. The first is a paper in the Review of Accounting Studies, and it was done in 2019. And this paper examined the effect of major customer concentration on firm profitability. So do companies with few customers that represent a large percentage of sales, do they do well or do they not do well? And this paper documents that major customer concentration is negatively associated with supplier firms' profitability, but positively associated with the major customers' profitability. So the company that is reliant on a small number of customers doesn't do very well because those customers have high bargaining power. But the customers themselves do very well in that arrangement. And the second piece of academic research is in the Journal of Accounting and Economics, Customer Concentration Risk and the Cost of Equity Capital. And this paper says our results show a positive association between customer concentration and a supplier's cost of equity and debt capital. And this relation is more pronounced for suppliers that are more likely to lose major customers or that are more prone to larger losses if they lose such customers. We also provide evidence that a supplier with a concentrated base of safer government customers has a lower cost of equity. So in general, higher customer concentration is going to increase the cost of equity and debt capital. So it increases the risk of the company.